Our market monitor guest tonight is confident that the stock market still has more room to run, and he favors value stocks over growth stocks. He's Mark Tepper, president of Strategic Wealth Partners. Welcome, Mark, to Nightly Business Report. Let me begin by talking to you about your strategy here. Why value, and how hard is it to find value stocks?
Why value? So, typically when an economy is pretty weak and just emerging from a recession, investors they prefer growth stocks over value stocks due to the fact that they're not getting much growth out of the economy. However, we're currently in a place right now where the economy is strengthening. And when the economy actually begins to strengthen, value stocks consistently outperform growth stocks. So, there's a lot of critics out there that'll say that there's no value left right now. We're looking at a forward multiple on the S&P 500 of 15.7, which is pretty much in line with historical averages. And there's a lot of people that say, well, it can't go any higher, or if it does, it's overvalued.
Right.
Look, these times are different. We're looking at a very low interest rate environment. Capital is going to chase yield, and you see a lot of money moving up the risk ladder. So, we're confident that the multiples could expand up to about 17 or so before we would actually pull back our overweight rating on stocks to equal weight.
You say the two most undervalued and unloved sectors right now are energy and financials. I mean, with the price of oil going higher, I can imagine that might change. But be that as it may, you still like a company like Chevron, right?
We do, yeah. I mean, when you look at the energy sector, it makes up 13% of the market's earnings, but only represents 10% of the market's cap weighting. So there's a ton of long-term potential for the energy sector to recapture some share of GDP. When you look at Chevron, it's a great dividend play. A lot of our clients have transitioned into either selling their businesses or they're retiring. It's a great dividend play. It's got a good valuation. And the one thing about Chevron over the course of the last few years is it's been unloved due to the fact that it's been investing a lot in the form of capital expenditures. Management recently came out and said 2013 was a peak spending year, and that spending should flatten out through 2016. So it looks pretty promising for Chevron.
All right, tell us about ConocoPhillips trading now around $85. You have a target of 100 on this stock. Why do you like it?
Yeah, again, another good energy play, good dividend, good valuation. The one thing that really stands out about ConocoPhillips is the fact that it's got some diversification. So it's not just oil. It had this massive acquisition years ago where it did everything it could to get into the natural gas space. So it gives us an energy component in our portfolios without being strictly dependent upon oil.
Among the financials, you like Wells Fargo. Of course, they're the largest mortgage lender in the land. Is that a bet on the housing market?
No, not at all. I mean, that is one of our concerns is the high exposure that Wells Fargo does have to the mortgage industry. We want to be in financials. Again, we think financials, just like energy, have the potential to capture some additional share of GDP. But Wells Fargo, even in the middle of all of the issues with the mortgage market, it's done a very good job of beefing up both its consumer loans and also its commercial loans. And we feel that those are going to be a really important part of banking business over the course of the next several years as businesses begin to really undergo some more capital spending to replace some aging capital stock that they haven't invested in over the course of the past decade.
All right, lots of good information. Any disclosures to tell us about, Mark?
Yes, we as a firm own all three companies in our client portfolios.
Okay, terrific. Thank you so much for coming on the program. Mark Tepper from Strategic Wealth Partners.